Your employer stops managing your cash flow the day you retire. From that moment on, you are the payroll department. Think about that for a second. For decades, someone else handled the timing. Every 2 weeks, a deposit landed in your account. Taxes were withheld. You didn't have to think about it. You just spent what was left. The day you retire, that stops. And here's what most people get wrong. They look at a number on a screen, a brokerage statement, a net worth calculation, and they think that number is their paycheck. It isn't. A number doesn't pay your electric bill. A house deed doesn't buy groceries. A share of Apple stock doesn't cover your property taxes. Only cash does those things. This is the liquidity problem, and it's the reason most people never actually retire, even when they could afford to. They have wealth, they don't have a paycheck. I'm Frank, and I'm here to show you how to build 3 assets that will replace your salary. Not someday, not maybe, but with a system you can actually execute. Let's start with the hardest part, converting what you've saved into what you can actually spend. You probably heard about the 4% rule, the idea that you can withdraw 4% of your portfolio each year and never run out of money. Sounds simple. Pull out 4%, live on it, repeat. But that rule was built on a very specific assumption. The market cooperates. If you retire in a year when stocks drop 30%, your 4% withdrawal is suddenly coming from a much smaller pool. And if you're forced to sell stocks at a loss to pay your bills, you're making a permanent mistake. You can't get those shares back once they're gone. The recovery happens, but without you in it. This is called sequence of return risk, and it's the reason a lot of retirees end up broke. The solution is what I call your fortress, and it's the most important asset you'll own in retirement. Your fortress is cash and short-term fixed income. We're talking money market funds, certificates of deposit, treasury bills, or short-term bond funds. They're not exciting. They don't promise to double your money. That's exactly why they belong in your plan. Here's how it works. You calculate your annual expenses. Let's say you need $50,000 a year to live. You then ask yourself, how many years of bad markets can I survive without panic selling? Some people choose 2 years. Some people choose 5. Some people choose 10. The number depends on your stomach for risk and your financial situation, but the principle is the same. You build a reserve of actual cash that covers those years of expenses. If you chose 5 years, that's $250,000 sitting in ultra-safe investments earning 4 or 5%. It's not thrilling, but here's what it does. When the stock market crashes, you don't care. You don't sell a single share. You just spend from your fortress. And while the market recovers, and history says it always does, your stock portfolio is working for you, not against you. You are never a forced seller. That changes everything. The fortress also solves a psychological problem most people don't talk about. For your entire career, you've been a saver. You put money in. You watched it grow. That's your identity. Retirement flips that switch. Suddenly, you're a spender. You're taking money out. For a lot of people, that creates guilt, even shame. The fortress eliminates that guilt. You're not drawing down your investments. You're spending the cash you set aside for exactly this purpose. It's pre-approved. It's planned. You can spend it without the constant worry that you're destroying your future. There's a tax that nobody debates and nobody votes on. It's called inflation, and it's silently cutting your purchasing power in half. At 3% annual inflation, which is roughly average over the last 100 years, your money is worth half as much in 24 years, not in 50 years, in 24 years. If you retire at 65, you'll be 89 when inflation has cut your purchasing power in half, and most of you will live past 89. This is why bonds alone will kill your retirement plan. I know bonds sound safe. They are. You know exactly what you're getting. A 4% treasury pays you 4%. You can sleep at night. But that 4% is being eaten by inflation. Your real return, the actual purchasing power you're gaining, is closer to 1%. Over a 30-year retirement, that's devastating. This is where your second asset comes in, the inflation killer. This is a broad portfolio of stocks. Now, I know what you're thinking. Stocks are risky, markets crash, and you're right. But the thing is, stocks are the only asset class that has consistently beaten inflation over long periods. Real estate does it, bonds don't, commodities bounce around, but stocks, a diversified portfolio of good businesses, they grow earnings, raise prices, and pass inflation along to customers. They survive inflation. They thrive in it. Look at the data. Over any 20-year period in the last 100 years, stocks have beaten inflation. Some 20-year periods were rough. The sequence matters, but none of them failed. The problem is volatility. Stocks can drop 30, 40, even 50% in a bad year. And that's where the fortress comes in. That's the entire reason we built it. When stocks crash, you spend from the fortress. You're not selling stocks at a loss. You're waiting for them to recover. And while you wait, your stock portfolio is still working, still earning dividends, still growing earnings, still fighting inflation for you. The fortress and the inflation killer are not separate strategies. They're one system. The fortress gives you safety. The inflation killer gives you growth. Together, they give you longevity.
We've covered safety and growth. Now we need something your portfolio can't give you: regularity. For 30, 40 years, you had a paycheck. It showed up on schedule, you knew what it was, you planned your life around it. Retirement flips that. Now your income is whatever the market decides to give you, 10% one year, negative 20% the next. Your third asset solves this. It's the income floor, and there are two main ways to build it. The first is dividends. A dividend stock is a share in a business that's mature enough and profitable enough to send cash directly to shareholders. You own a tiny piece of a company, and that company pays you quarterly for the privilege. Here's the appeal. If you own enough dividend-paying stocks, the dividends alone can cover your expenses. You never have to sell a share. Your portfolio sits there, growing, and it just keeps sending you cash. It's a paycheck from your investments. But, and this is important, not all dividend stocks are equal. There are stocks paying 8%, 10%, even 15% dividends. They sound incredible, and they are incredibly risky. A company paying 15% in dividends is either in trouble or lying about its earnings. Real dividend stocks, the kind that survive recessions and keep paying, tend to yield 3 to 5%. They're from established businesses with competitive advantages. They have strong balance sheets. They have management teams that have proven they can navigate cycles. This requires real research, or it requires you to work with someone who does that research for a living. The advantage of dividends is they're tax efficient if you hold them in taxable accounts. Qualified dividends get preferential tax treatment. You're also not forced to sell shares to access the income. The disadvantage is that dividend-paying stocks don't always go up with inflation. Some do. The really good ones raise their dividends faster than inflation historically, but not all. And if you own a dividend stock that cuts its dividend during a recession, your paycheck just shrank. That happened. It happened in 2008. It can happen again. So the income floor via dividends works, but it requires discipline and knowledge. The second way to build your income floor is through longevity insurance, specifically a deferred income annuity, a DIA. An annuity is a contract between you and an insurance company. You give them a lump sum of money now, and they promise to send you checks for the rest of your life, starting at some point in the future. This sounds like it should be popular, free money for life, but most people hate annuities, and for good reason. Most annuities sold are complicated, expensive, and designed to benefit the salesman more than you. I'm not talking about those. I'm talking about a simple DIA. You give an insurance company, say, $100,000 at age 60, and they guarantee you $500 a month starting at age 80 for the rest of your life. No matter what happens to the market, no matter what happens to the economy, that check shows up. Here's why this works in retirement. Most of your life, you don't need it. You're living off your fortress and the growth from your inflation killer. But at age 80, 85, 90, when you're old enough that you genuinely might not have time for the market to recover from a crash, this annuity has turned into your pension. It's guaranteed income. It's funded by your younger self who had time to take risk. It's elegant. It's not for everyone, but for the person who's terrified of running out of money at 95, it's a real solution. The downside is you have to give up the money now, and you don't get it back if you die at 79. You've lost that principal. Insurance companies bet on people dying before they break even. Some people do, some don't. It's a personal decision. So you have two paths to the income floor: dividends, which require skill and give you some potential for growth, or annuities, which require a sacrifice of principal and give you peace of mind.
Most of you will combine them, a little of each. Let me show you how this actually works in real life. You've retired. You need $50,000 a year to live. Here's your setup. Your fortress contains 5 years of expenses, $250,000 in money market funds, CDs, and short-term treasuries. Your inflation killer is a diversified portfolio of stocks, maybe $1 million. It earns, on average, 8% before inflation. That's $80,000 a year in growth and dividends. Your income floor produces $20,000 a year from dividend stocks you own, companies like Procter & Gamble, Coca-Cola, Johnson & Johnson. Boring companies, profitable companies. You need $50,000. You have $20,000 coming in automatically. You need $30,000 more. In a normal year, when the market is up, you don't touch anything. Your $20,000 in dividends covers 40% of your expenses. Your inflation killer portfolio grows, your fortress sits there, ready. But then, the market crashes 30%. Your inflation killer is now worth $700,000 instead of $1 million. Everyone panics. Financial channels are screaming that the world is ending. You don't care. You spend from the fortress this year and next year. You live on your $20,000 in dividends plus cash from your fortress. You're not selling a single stock at a loss. The market can be down for 3 years. You have 5 years of cash. You can wait. And while you wait, something mathematical happens. The market recovers. It always does. Your stocks go back up. Your inflation killer regrows. And when it's back to $1 million, you do something critical. You refill the fortress. This is the discipline part. This is where most people fail. When the market is roaring, when your portfolio is up 30%, you feel rich. The temptation is to spend it. The correct move is to sell some of those winners, take those capital gains off the table, and rebuild your cash reserve. This is not intuitive. This is doing the opposite of what you feel like doing. But this is how you survive 30, 40, 50 years of retirement without a paycheck. The fortress protects you from sequence of return risk. The inflation killer builds long-term wealth. The income floor gives you the psychological comfort of a regular paycheck. Now, there's one more thing you need to understand because a lot of people get this wrong. This system is not set it and forget it. You don't build your 3 assets on January 1st and then never touch them again for 30 years. That's a recipe for disaster. Here's why. The market changes. Your life changes. Tax laws change. The behavior of each asset changes. You need to actively manage the system. The most important management is the rebalancing. Let's say you started with $500,000 in your inflation killer and $250,000 in your fortress, a 2-to-1 ratio. After a great year, your inflation killer has grown to $600,000. Your fortress is $250,000. Now it's a 2.4-to-1 ratio. You're getting too aggressive. You've got too much in stocks and not enough in safety. So you sell some winners from your inflation killer, capturing those capital gains, and you move the proceeds to your fortress. You're taking profits when the market is high. You're not changing your asset classes. You're not changing your strategy. You're just maintaining discipline. The second management task is the refill. When your fortress drops below your target level, maybe you spent from it during a down year, you refill it from the gains in the inflation killer. The third is annual evaluation of your income floor. Are your dividend-paying stocks still safe? Have their fundamentals changed? Are they still the quality you bought? For most of you, this will be a once-a-year conversation, maybe with a financial advisor. For some, it will be more frequent. This is not work. It's not 20 hours a week of research, but it is engagement. It is the opposite of passive, and that's okay. You're managing your own payroll department now.
Payroll requires attention. Let me bring this back to where we started. Your employer stops managing your cash flow the day you retire. You become the payroll department. The fortress is your cash account. It's the account that pays out your bills when the market is down and the regular income stops flowing. The inflation killer is your investment account. It's where you store growth and bet on the future. It's the reason your spending power doesn't get cut in half over 24 years. The income floor is your income stream. It's the check that shows up, like clockwork, reminding you that you're not eroding your wealth. You're managing a sustainable cash flow. Together, they do what no single asset can do alone. They give you safety in the short term, growth in the long term, and peace of mind in the present. This is what you spent your career building toward. Not a number on a screen, not a net worth statement. This, a sustainable, reliable, tax-efficient paycheck that flows from the assets you own. The good news, you already know how to do this. You've been managing a household budget for decades. You understand income and expenses. You understand the difference between a need and a want. The hard part is shifting from accumulation to distribution. The hard part is believing that you can spend. The hard part is staying disciplined when the market is screaming at you to panic. But the system works. It has worked for hundreds of thousands of retirees. It will work for you. Your job now is to build your fortress, fuel your inflation killer, and establish your income floor. Then and only then can you actually retire. Thanks for watching. Now, before you go build your paycheck, YouTube recommends you watch this video next. See you there.